Welcome to the deep dive. Let's plunge into a fascinating story, really. The one that underpins the modern global economy. How the US dollar became the dominant force.
Yeah, it wasn't always number one.
Hmm.
And we've pulled together quite a bit of material, articles, research notes, even a really interesting look at the history from a YouTube source.
Right. And our mission, as always, is to sift through all that, find the really crucial bits, and understand how this huge shift happened.
Exactly. Get to the core of it.
And interestingly, to start understanding the dollar's rise, we're actually going to begin somewhere incredibly secure. Think Fort Knox, Kentucky.
Oh, yeah, the sources paint quite a picture. We're talking like, multiple fences, barbed wire,
Where?
one's even high voltage.
Bring Hines.
Apparently, yeah, minefield around it. Armored guard posts, machine gunners, the whole setup. The walls themselves are like half a meter thick.
Wow. And the door. The main vault door.
Get this explosion-proof, 20 tons. It needs several officers, each with their own unique combination, just to start the opening process.
Just to start it.
Yeah, and then the sources say it takes 100 hours. 100 hours to actually open it fully.
That's unbelievable. Plus, military units nearby, a whole infantry division HQ. Very few people have ever actually been inside.
So all that security, what's it protecting?
Gold. A massive amount. 147 million troy ounces of U.S. gold reserves. Worth, what, almost $460 billion today?
And that's more than half of the total U.S. gold reserve, right?
Exactly. Which brings us to the big question, the apparent contradiction. You guard gold like this, but as our sources point out, the dollar hasn't actually been backed by gold for, well, over 50 years now. The gold standard ended.
So why keep guarding it so fiercely? And, how did the dollar get to be number one in the first place if that link to gold wasn't permanent?
To figure that out, we need to leave Fort Knox, go back in time a bit.
And head north, right, to New Hampshire.
Way back, July 1944, Bretton Woods, New Hampshire, the Mount Washington Hotel.
Mid-war. The world's still burning, basically.
Yeah.
Allies are liberating France, the Soviets are pushing west, but delegates from 44 allied nations are gathered there.
Looking ahead, trying to figure out the post-war financial system. How to make it stable this time.
And our sources really zero in on two key players, two main perspectives clashing. For the U.S., you had Treasury Secretary Morgenthau, technically heading the conference, but the real intellectual force was his assistant, Harry Dexter White.
Okay. And the other side?
Great Britain, represented by, well, John Maynard Keynes, who the sources call, one of the absolute giants of 20th century economics.
So it really boils down to this kind of intellectual battle, White versus Keynes.
Pretty much. And the sources explain why it was mainly these two. I mean, other European countries were devastated, focused on rebuilding. Germany wasn't even invited. China wasn't a superpower yet.
And the Soviet Union.
They were there, but ultimately they didn't sign on to the final model. They went their own way for, 45 years?
Yeah.
So yeah, it was America holding most of the cards with Britain as the main sort of opposing voice.
Okay, so they disagreed on the big picture, but they did agree to create a couple of major global institutions, didn't they?
They did. Two big ones came out of Bretton Woods. First, the International Monetary Fund, the IMF.
The IMF, right. Its job was issuing credits, short-term help, like the sources mention Russia getting help in the 90s.
Exactly. Helping countries with balance of payments issues, trying to keep currency stable. Though, yeah, didn't stop the Russian default eventually.
And the second institution?
The International Bank for Reconstruction and Development, or IBRD, which basically became the foundation for the World Bank.
Okay, IBRD, World Bank, and its focus was different.
Initially, yes. Very much about rebuilding Europe after the war. But then it shifted, providing long-term loans for, like, infrastructure projects, social programs, mainly in developing countries in Africa and Asia.
Sources mention there's criticism of the World Bank too, but that's another topic.
Right, for another time. But yeah, IMF, short-term stability, currency issues, World Bank, long-term development projects. And understanding why they took these specific roles really comes down to that White versus Keynes debate.
Let's get into that. White's plan for the U.S., what was the core idea?
Okay, so White's vision was pretty straightforward, in a way, fixed exchange rates. Most major currencies would have a fixed value against the U.S. dollar.
Pegged to the dollar. And the dollar itself.
The dollar would be pegged rigidly to gold at a specific rate, $35 for 1 troy ounce of gold.
So a two-step system, currencies to the dollar, dollar to gold. What was the thinking behind that?
Stability, mainly. And, crucially, it was meant to stop countries, including the U.S., from just, printing money endlessly.
Hmm.
If your currency is tied to the dollar and the dollar is tied to a physical thing like gold whose supply only grows slowly, it puts the brakes on inflation.
Limits monetary expansion, keeps things tied to something real, theoretically.
Exactly. Economic growth couldn't outpace gold accumulation in theory.
But why the dollar? Why put it right in the middle? Couldn't everyone just peg to gold directly?
Well, practicality was a huge factor. Imagine trying to settle every international trade deal by shipping gold bars around. It's heavy, costly, just inconvenient.
Right.
The dollar, in White's system, became like a convenient stand-in, a certificate for gold almost. $35 was an ounce of gold, held securely somewhere like Fort Knox. Using dollars just made global commerce much, much smoother.
Okay, smoother, but doesn't that automatically make everyone dependent on the U.S.? That feels like a big power play.
Oh, absolutely. And that was definitely a point of tension. But White could argue it reflected reality. Our sources point to Fed documents from '45 showing the U.S. held a staggering amount of the world's gold in 1944.
How much?
Like 18,500 tons. Compare that to France or Britain, maybe 2,000 tons each.
Whoa, that's
Yeah.
that's not even close. Why did the U.S. have so much?
Years of turmoil in Europe. The run-up to the war itself. Countries, investors, they saw the U.S. as the safe haven. So gold flowed there. Think about Germany annexing Austria. In 38, people wanted their assets safe.
So White wasn't just speaking for the U.S., he was speaking for the country holding most of the world's gold. Huge leverage.
Exactly. He represented the main gold storage of human civilization, as one source put it.
Okay, that makes sense of White's position. What about Keynes? What was his alternative? He wasn't just trying to get Britain back on top, was he?
No, the sources suggest not. Britain was actually in debt to the U.S. by then. They only paid off their last WWII loan in, 2006? Keynes seemed to be aiming for something more balanced, a just global system, as he saw it.
And his big idea was this Bancor currency.
Precisely. Instead of using a national currency like the dollar, he proposed creating a brand new neutral international currency, just for settling international trade accounts. That was Bancor.
And how would it work?
He also proposed an international clearing union, like a central global exchange where all these Bancor transactions would happen. National currencies would peg to Bancor. Bancor would be linked to gold value somehow, but it wouldn't be any single nation's currency.
Bancor sounds like banking gold in French almost.
Yeah, that's the likely origin, a truly international reserve asset.
Seems more equitable, maybe. Why didn't it happen? Why did White's dollar-centric plan win?
Well, this is where the sources point to the politics. Bretton Woods wasn't an academic seminar. It was politicians making decisions based on power. Keynes had the economic arguments, maybe, but the U.S. had the overwhelming political and economic weight in 1944.
So U.S. influence trumped Keynes's theory.
Pretty much. Bancor remained an idea, the dollar took its place, and the IMF, well, it became a sort of scaled-down version of Keynes' clearing union idea.
Okay, so the dollar gold standard it is. Fixed exchange rates. But you mentioned earlier, fixed rates cause problems with trade imbalances, right? Normally, currencies float to fix that.
Exactly. If you run a trade deficit, normally your currency weakens, makes exports cheaper, imports pricier, and things tend to balance out over time. Same in reverse for a surplus. Fixed rates stop that automatic adjustment.
So how did the Bretton Woods system handle that? That's where the IMF came in again.
Yes, that was its key role in this fixed-rate world. It acted as this international reserve pool. Countries running deficits could borrow from the IMF to cover the gap, giving them breathing room.
And countries with surpluses.
They essentially contributed more to the fund. They had higher quotas. It was a way to recycle those surpluses.
Did the IMF allow any changes to exchange rates?
Some, yes. If a country had a really persistent fundamental imbalance, the IMF could approve a devaluation weakening its currency against the dollar. Or, for a chronic surplus country, a revaluation strengthening it.
So countries gave up some control over their currency value?
In exchange for stability and the promise of IMF help if they got into trouble. That was the trade-off.
But one rate was untouchable, you said.
The crucial one. The $35 per troy ounce of gold. That could not be changed. It was the anchor, the bedrock of the whole system. But, as our sources put it, it was also a ticking time bomb.
Right. And that bomb eventually went off. What was the fundamental problem with keeping gold fixed at $35?
The core issue, looking back, was this growing gap. The number of dollars circulating around the world kept increasing.
Because global trade was growing and everyone needed dollars for it.
Exactly. But the amount of gold the U.S. held, valued at that fixed $35 an ounce, wasn't keeping pace. In fact, it started shrinking.
Can we put numbers on that again?
Yeah, the sources mentioned that by the late 1950s, you had something like $50 billion out there in the world economy, but the U.S. gold reserves, at 35 anodes, were only worth about $20 billion.
That's a big gap, and it just got worse.
It widened significantly through the 60s.
Why?
Well, global GDP boomed, trade exploded, so the demand for dollars went way up. At the same time, the U.S. was obligated under Bretton Woods to sell its gold for dollars at that fixed $35 price to foreign central banks.
So dollars flowed out? Gold flowed into other countries.
Gold flowed out of the U.S. Foreign countries earned dollars from trade, then presented those dollars to the U.S. Treasury and said, "We'll take the gold now, thank you very much." The sources talk about the Fort Knox shelves emptying. The printing press for dollars was running faster than gold was coming in.
It's an economic contradiction, isn't it? Gold, the supposed backing, is getting scarcer relative to the dollar, which is getting more plentiful.
Precisely. In any normal market, the price of gold in dollars should have gone way up, but it was fixed, locked at $35.
And other countries, particularly in Europe, they noticed this.
Oh, absolutely. They were accumulating huge piles of dollars from exporting goods to the U.S. They looked at the shrinking U.S. gold reserves and realized gold was seriously undervalued at $35. So they started converting their dollars into gold more aggressively. It was perfectly legal under the rules, but it put immense pressure on the U.S.
The U.S. must have seen this coming.
They knew what was happening, yeah. But they were kind of trapped by the system they themselves had created. The very thing that made the dollar dominant, being the reserve currency exchangeable for gold, was now draining their gold reserves.
Okay, so the pressure builds and builds, leading us to 1971, the breaking point.
Things were getting really intense. Our sources highlight this crucial meeting, August 2nd, 1971. Nixon, Treasury Secretary John Connally, Chief of Staff Haldeman.
What was the news?
Bad. Haldeman reported France had just pulled out over $1 billion worth of gold recently. Germany, the Netherlands were lining up to demand more. Connally's estimate was grim. Maybe a $3 billion gold loss by year-end if they didn't act.
Yikes. What did Connally suggest?
His solution was blunt. Just stop. Stop exchanging dollars for gold. Period. He figured the world would probably move to floating exchange rates after that anyway. Let the market decide what currencies and gold were worth.
Let the Fort Knox gold price float. And the sources mention the British perspective, too, through secret memos.
Yeah, that's fascinating. Memos from the Bank of England in July 71. They held about $4 billion in reserves. One secret memo talks about the consequences if the U.S. stopped gold conversions. They knew trying to cash in all their dollars at $35 might crash everything.
I catch 22.
Totally. Then a top-secret memo later that month says a U.S. refusal would open Pandora's box, threatening the whole international cooperation setup.
So they saw the writing on the wall.
Pretty much. By August 10th, another top-secret memo shows they basically accepted the system was collapsing. They were debating damage control. Should they demand gold now? Pay off debts, get U.S. credit. They noted demanding gold would likely just trigger the U.S. refusal they feared.
Someone had to make the move. And the sources say the British did.
Yes. On August 12th, the British ambassador formally asked the U.S. Treasury to convert $3 billion of their holdings into gold. The sources call this the last shot, the demand that finally broke the system.
And Nixon's reaction.
Emergency weekend meeting at Camp David with his economic team. They hammered out the plan.
And then the big announcement?
Sunday evening, August 15th, 1971. Nixon goes on TV, interrupts the regular shows like Bonanza, I think it was.
Interrupts Bonanza. That's serious.
Right. And he announces it. The U.S. will no longer convert dollars into gold at the fixed rate for foreign governments. The gold window was slammed shut.
America essentially defaulted on that Bretton Woods promise.
In effect, yes. The Bretton Woods system, built on that fixed dollar-gold link, was dead. The gold standard for the dollar was over.
Gone. From that day on, the dollar wasn't secured by gold anymore?
Nope. It became a fiat currency. Its value based on faith in the U.S. government and economy, not a pile of metal.
Now, one interpretation you hear, and it's in the sources, is that the U.S. did this simply because they wanted the freedom to print more money, right? To remove the constraint.
And, well, it's true. Since 71, U.S. monetary policy hasn't been tied to how much gold is in Fort Knox. They can create more dollars without worrying about gold convertibility at a fixed price.
And you just have to look at the gold price since then to see the effect.
Absolutely. It's gone up, what, roughly 100 times against the dollar? Which definitely suggests the dollar has lost a lot of value relative to gold since 1971.
But the sources offer a counter-argument. This idea that the dollar being unsecure wasn't necessarily a bad thing, a bug, but maybe a feature.
It's a really interesting perspective. Think back to what we said earlier. If the world's main currency, the dollar, had its supply strictly limited by the amount of gold the U.S. had, or could mine.
Which changes very slowly.
Right. That would have acted as a massive brake on global economic growth. International trade needed a rapidly expanding medium of exchange, and tying it strictly to gold just couldn't provide that flexibility. It would be like limiting global growth to the speed of gold mining.
Like we discussed with the Great Depression, a lack of money supply can strangle an economy.
Exactly. So the argument goes, untying the dollar from gold, while it led to the dollar devaluing against gold, actually allowed the global economy to grow much faster than it could have otherwise. It removed that physical commodity constraint.
So now gold, dollars, other currencies, they all just trade like commodities on the open market.
Pretty much. Their values are set by supply, demand, speculation, confidence, all the complex market forces, not a fixed government peg to gold.
Which circles back to the question the sources raise. If the dollar isn't backed by gold, hasn't been for 50 years, why is it still so dominant? Why is there still such huge demand for it globally?
That's the multi-trillion-dollar question, isn't it? Clearly, having vaults full of gold isn't the only thing that gives a currency global power, even if it helped kick things off.
And the world economy certainly didn't collapse after 1971. Global trade grew immensely, though we also had financial crises, and the IMF adapted its role.
It's a different world, financially speaking. Maybe something for a future deep dive.
Definitely. So let's quickly recap. We start at Fort Knox, the symbol of the old gold backing. Then Bretton Woods, 1944, the big showdown. White's dollar-gold plan wins over Keynes' Bancor. The IMF and World Bank are born.
Then the system comes under strain. That fixed $35 price becomes unsustainable as the world economy booms and dollars flood out, draining U.S. gold.
Leading to the dramatic weekend in August 71. Nixon closes the gold window. The Bretton Woods system collapses. The dollar floats free.
And we end with this thought. Was ending the gold link a bug, allowing uncontrolled money printing, or a feature, enabling decades of global growth, albeit with inflation relative to gold?
So now that you know this history, how does it change how you think about the dollar's role today, its value, especially now that it's not tied to that gold in Fort Knox?
And maybe the final question to leave you with, drawing from the sources, if it's not gold anymore, what does drive the demand for the dollar today? What makes it the currency the world still largely runs on, even without that physical anchor?
Something to think about. We'll see you next time on The Deep Dive.